Hello, everybody. Myself Nilesh Shah, and I'm the founder and virtual CFO for Nilesh Shah Financial Services Firm. Welcome to the today's live event: 7 cash flow mistakes e-commerce owners make and how to fix them. Now, first of all, let's talk about why I choose to work for e-commerce business owners. So 10 years ago, I used to have my own e-commerce store, and by doing my e-commerce activities, I learned a lot of mistakes. I learned from a lot of failures, and I want to make sure that you don't make the same mistakes. And by qualification, I'm a chartered accountant and a fractional CFO, and we provide accounting, bookkeeping, and CFO services for e-commerce business owners. So that's my background about the firm. So today's topic is the cash flow mistakes, what we can do to improve our cash flow. So let me share you my screen that I have made a PDF for the cash flow mistakes, and I would love to share with you guys. And here we go. 7 cash flow mistakes that put e-commerce stores out of business. So I made this ebook for e-commerce business owners, and I needed to go through with this ebook. In a short term time, I'm going to explain what cash flow mistakes every e-commerce owners make. And if you want to download this ebook, just message me or comment on my live event or subscribe to my email address on www.nileshshahca.com. NILESHSHAHCA.com. So let's take an introduction. Like e-commerce is one of the most exciting business models in today's economy, thanks to Jeff Bezos and other innovators, AI technology to make e-commerce platform very smooth and easygoing. Now, cash flow mistakes don't usually announce themselves loudly. Based on the research, 82% of small businesses fail because of cash flow mismanagement, and e commerce businesses are especially vulnerable because of inventory cycles, high return rates, and razor thin margins. So, by understanding and fixing these mistakes, you will gain clearer insights into the real numbers. We can make actual decisions based on the real numbers. We need the real numbers. Without real numbers, we are going nowhere. Protection from financial risk that quietly bleed your profits. A stronger foundation to scalability without running out of cash. So number one is ignoring the true cost of returns. Every single business owner goes through with the returns. Every refund is just lost revenue. It carries hidden cost that quietly chip away at your margins. For example, non-recoverable shipping cost you already paid to couriers like FedEx and UPS, packaging materials that can't be reused, labor cost for inspecting and restocking items, inventory write-offs when products come back damaged or unsellable. So, guys, this is very dangerous. And why is it dangerous? Because the biggest risk is making strategic decisions based on false data. Ignoring the true cost of returns, let me give you the real world example. Let's say store generates $50,000 in sales this month. That looks fantastic on the surface, but if 20% of those orders are returned, you are immediately down $10,000 in revenue. Add in another $2,000 in hidden return cost like shipping, labor, packaging, and suddenly your so-called bestseller is barely breaking even. That's $12,000 of cash flow gone out of the 50,000 US dollars. Now, how to protect your cash flow? Track return rates at both the store level and the product level. Identify products with unusually high returns and ask whether they are worth keeping in your catalog. Adjust pricing, product discrimination, descriptions, or supplier quality to reduce returns. Always calculate the net profit after returns, not gross sales. Number two is overlooking sell tax liabilities. Selling across state lines or even intentionally sounds like an incredible growth opportunity, and it is. In the US alone, each state has its own rule for what it's called nexus. We all aware about the nexus. Some states use revenue threshold while others use traction counts. In fact, just 200 transactions in a state can trigger the requirement to collect sales tax. So why it is so dangerous? Even worse, failing to comply can damage your reputation with states and tax authorities that flag your business for closer scrutiny. Customers, if you suddenly begin charging tax where you hadn't before, investors who see unpaid liabilities as a red flag. So, those are the mistakes. Now, mistake number three, mismanaging buy now, pay later, and payment processor fees. Mismanaging buy now, pay later options like Klarna, Afterpay, and Affirm have exploded in popularity. But for e commerce businesses, buy now, pay later isn't free money. It introduces complexity and hidden cost that often get overlooked. Why it's so dangerous? Because on paper, everything looks fine, but when supplier invoices or ad bills come due, you realize the funds aren't there yet, or they are already been reduced by fees you don't even fully track. Let me give you a real world example. Your Shopify dashboard proudly shows 100,000 in sales. You celebrate and order more inventory. When you check your bank account, you only see $92,000 available. Where did the missing $8,000 go? Buy now, pay later fees and merchant charges, chargebacks from the disputed transactions, settlement delays. Now, how to protect your cash flow under these circumstances? Reconcile your sales dashboards to your bank deposits regularly, which is required. Track buy now, pay later fees and processor charges as line item expenses, not afterthoughts. Forecast payouts based on actual settlement schedules, not just sales totals. And consider consolidating processors where possible to simplify reconciliation. So, payment processors and buy now, pay later aren't the enemy. They are powerful tools for your growth. But if you don't account for their fees, timelines, and risk, you will always wonder why the cash in your account never matches your sales reports. Number four is misunderstanding the true value of inventory. For most e commerce founders, inventory is the single largest investments, and we all agree on this. Many rely on Shopify, Amazon, or warehouse dashboards to sell your e commerce products, your inventory. You might think that you have $200,000 worth of inventory sitting on your shelves, but if part of that is damaged, outdated, missing due to shrinkage, or tied up in slow moving products, the number is inflated. And worse, that $200,000 isn't cash, it's money you have already spent and can't use to pay today's bills. So, this is very dangerous. Over ordering, you tied up precious cash in products that sit unsold for months, leaving your cash poor even though your warehouse looks full. And under ordering is also a problem. You run out of your best sellers, missing sales opportunities, and wasting and ad spend that drives customers to out of stock items. So both these mistakes can cost you. Number five is underestimating shipping and fulfillment cost. A real world example, I want to give it to you. Let's say your reports show $50,000 in inventory ready to sell, and you are very confident. $10,000 is last season's styles that no longer move. $5,000 is damaged goods you can't resell, and $3,000 has been lost to shrinkage or miscounts. That means only $32,000 of your inventory is actually sellable. The rest is a sunk cost, and your cash flow suffers because that money is already tied up in products that won't generate revenue. So, how to protect your cash flow under this situation? Number one, regularly perform physical inventory counts to confirm the real numbers. Number two, track aging inventory to identify slow moving products. Number three, use proper costing methods like FIFO, first in, first out, or weighted average to calculate true margins. Balance inventory purchases with cash flow forecast, not just sales projections. So, what are the key takeaways out of underestimating the shipping and fulfillment cost? Inventory isn't just a number on your balance sheet, it's your cash locked in boxes on a shelf. Without accurate tracking and valuation, you risk making poor purchasing decisions that quietly drain your profitability month after month. Mistake number five, underestimating shipping and fulfillment cost. E-commerce business owners, they spend lots and lots of money on shipping and fulfillment cost. So this is a very important as- aspect of your business. Couriers fees that increase without warning, which happens every now and then. Actually, it's usually packaging materials, inserts and labels. They are expensive these days, especially with the tariff. Third party logistics, storage and pick and pack fees, international duties and surcharges, returns and reships. So this is very dangerous. Why? Shipping is one of the most common silent killers of cash flow in e-commerce. If you don't know your true landed cost per product, you can't price effectively. That means you could be scaling a business model that actually loses money with every order you ship. Let's take an example. You sell a product for $40 and calculate that it cost you $25 to source. On paper, you expect a $15 profit per order. But once you include $8 in shipping, $4 in packaging, $5 in third party logistics fees, your profit is actually negative $2. Every order shipped feels like a win, but you are losing money each time a package leaves the warehouse. So, how to protect your cash flow under this situation? Calculate true landed cost per product, including shipping, packaging, and fulfillment. Number two, negotiate with couriers or third party logistics to lock in best rates. We can always do that, right? Pick up your phone, write an email, follow up, do your thing. Reassess your pricing strategy to ensure it covers fulfillment expenses. And the last, regularly review and adjust for courier surcharges and hidden fees. So we need to review these charges in order to make sure that we don't make mistakes. So what are the key takeaways? If you are not tracking the full cost of fulfillment, you are flying blind. Shipping can quietly turn profitable products into money losers, draining your cash flow even as your sales grow. So, guys, be careful with your shipping and fulfillment cost. Make sure you have a proper pipeline in place to accumulate and display this cost in your finances. Number six, relying too heavily on platform dashboards. Platforms like Shopify, Amazon, Etsy, Walmart are designed to do one thing exceptionally well: drive transactions, increase your revenue, but they are not designed for its financial accuracy. So, what are the problems here? Merchant processing fees, advertising expenses, chargebacks, deferred revenue or unsettled transactions, discounts, and promotions. These are the problems, and why it is so dangerous. When you rely solely on platform data, you are essentially running your business on half the numbers. The danger isn't just overconfidence, it's making real financial decisions on incomplete information. This becomes especially costly. Let me give you the real world example. Your Amazon dashboard proudly shows $250,000 in quarterly revenue. It's very exciting. But out of that, $15,000 is merchant fees, $20,000 in ad spends, and $10,000 in chargebacks and returns. So your true revenue is $205,000, not $250,000. That $45,000 gap could be the difference between profitability and breaking even or worse. So, how to protect your cash flow under this situation? Use accounting software to reconcile platforms reports with bank deposits. Track all cost, fees, ads, chargebacks as separate categories, not hidden inside sales. Regularly compare platform data against financial statements to spot discrepancies. This is where us as an accountant come in the picture. Treat dashboards as sales tools, not the financial truth. This is very important. Treat dashboards as sales tools, not financial truth. So, what are the key takeaways? Platform dashboards are a great way to track orders and revenue trends, but they don't tell the full financial story. Without proper accounting, you risk scaling based on inflated numbers, and that can destroy your cash flow faster than you realize. So, here, this was the mistake number six, and now mistake number seven, failing to forecast cash flow. This is very, very important. Failing to forecast cash flow. Most of the business owners, they think like, okay, we can do our own bookkeeping, we can make profit and loss statement, we can make balance sheet, I can do all these things, research and stuff. But what about forecasting your cash flow? Where you want to be after 1 year or 2 years or 5 years? All your goals, they depend on your cash flow. If there is no cash flow, or the cash flow is tight, or the cash flow is negative, you will run into a problem, and it will be hard to solve that issue at that stage because you never took an action right from the starting point when you started your business. So it's better to be safer than sorry. So let's dive into this. E-commerce is especially vulnerable to this because of its unique cash flow cycles. Payment processors often delay payouts by several days. That's number one. Inventory must be purchased weeks or months before it generates revenue. Number three, ad spend spikes seasonally but doesn't always convert immediately. Returns and refunds hit at unpredictable times. And this is very dangerous. Why? Cash is the oxygen of your business, and we all agree to this. There are no ifs and buts. And without it, you can't pay suppliers, fund ad campaigns, or make payroll. Even businesses that look wildly successful from the outside can fail because they simply run out of liquidity. The most sobering reality: 82% of businesses that fail because of cash flow problems is the main reason. Let's take an example. $100,000 of your cash is tied up in prepaid inventory. $50,000 is stuck in a processor payouts that won't hit for another week. $25,000 is owed in cell tax you hadn't set aside. This is a problem. So on paper, you look like $1 million brand, but in reality, you are weeks away from running out of money. So how to protect your cash flow? Implement rolling cash flow forecast that project 3 to 6 months ahead. Match your inventory orders to your cash position, not just sales projections. Keep a cash reserve for emergencies and unexpected expenses. Reconcile frequently to ensure the cash you think you have matches what's available. This is very important. Reconcile frequently. I will say again, reconcile frequently. So, what are the key takeaways? Profit doesn't pay the bills, cash does. And we all agree on this. Without forward looking cash flow forecasting, you risk overextending yourself and suffocating your business right when it's poised for growth. So, cash flow forecast is very, very important. So, besides maintaining your books of accounts, every business owner should know their forecast for after 1 year, 2 years, 5 years, where they will be, how much will be their bank balance, what will be their revenue, and that does keeps you on track and on your goals. So, guys, I'm Nilesh Shah. I'm chartered accountant and a certified QuickBooks Pro advisor, a founder of Nilesh Shah Financial Services. My passion for e-commerce accounting comes from personal experience. As I said, like I used to have my own Shopify store selling designing clothes, like many founders. The result: hidden cost, poor inventory management, and payment processor confusion that drained my profits and left me in a confusing mode. So these are the painful lessons that I shaped my work. And today, as a chartered accountant and founder of Nilesha Financial Services, I now specialize exclusively in helping e-commerce entrepreneurs avoid the same mistakes. So, guys, I have made this ebook specially for e-commerce business owners. I have spent lots and lots of hours and hard work in designing this ebook, and it's free for you. You can go to my website nileshshahca.com, nileshshahca.com, and you can subscribe in my pop-up window, and you will get a ebook. So I need you to go through with this ebook and let me know if you have any questions. In meantime, you can comment and tell me what exactly you need. Thank you so much and see you soon.